Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Hey everyone, and welcome back to the channel where we deep dive into the fascinating world of hard-to-borrow stocks and short squeeze potential. Today we're putting a specific microcap on our microscope, CLRO or Clear One. This stock has hit our screener with some truly eyebrow-raising numbers, and we're going to break down exactly what makes CLRO stand out in the current market, even with some very unusual trading data. Show CLRO ticker and basic stats on screen. CLRO, trading as Clear One, is currently categorized as a microcap stock. While we don't have a specific sector assigned right now, what truly grabs our attention isn't its industry, but its status on the hard-to-borrow list. Looking at the recent price action, CLRO has shown 0.0% change today, 0.0% over the last 5 days, and 0.0% over the last 30 days. Similarly, its trading volume today stands at 0 shares, with a 30-day average volume also at 0 shares, resulting in a relative volume of 0x average. These numbers are highly unusual and point to extremely low liquidity right now, which we'll discuss further. What is cost to borrow and why it matters? Before we get deeper into CLRO's specific situation, let's quickly explain one of the most critical metrics we track, cost to borrow, or CTB. Show animation stock chart with CTB fee overlay. When you short a stock, you're essentially borrowing shares from a broker, selling them, and hoping to buy them back later at a low price. But borrowing those shares isn't free. Brokers charge a fee, known as the cost to borrow. This fee is typically expressed as an annualized percentage. Why does it matter? Because a high CTB indicates high demand to short the stock coupled with a limited supply of shares available to lend. For short sellers, it's a direct operating expense. The higher the CTB, the more expensive it is to maintain a short position, and yes, these fees can easily exceed 100% annually when demand is high and supply is scarce. Why this stock is hard to borrow right now? So, why is CLRO on our radar with these specific numbers? Let's dive into the data. Show data points on screen, highlighting each. First, CLRO's annualized cost to borrow fee is a staggering 819.5%. That's not a typo. To put that in perspective, anything over 10% is considered high, so 819.5% is exceptionally extreme. Even more telling, the CTB momentum for CLRO has shot up by an astonishing plus 806 percentage points over just the last 5 trading days. This indicates a rapid and significant increase in the cost to short this stock. Now, here's where it gets truly wild. The shares currently available to borrow stand at a mere 100 shares. Yes, just 100 shares available across the market for short sellers to borrow. This tiny supply is contrasted with an estimated float of 0.7 million shares. A float this small already makes a stock susceptible to volatile moves, but when you combine it with virtually no shares available to borrow, it creates a very tight situation. Our internal composite squeeze score for CLRO, which combines CTB level, CTB momentum, shrinking borrow supply, float size, volume/price momentum, and technical setup, sits at a robust 82.6 out of 100. This is a very high score, signaling significant squeeze potential ingredients. However, we must address the elephant in the room, the zero volume and 0.0% price change. While the hard-to-borrow metrics for CLRO are screaming, the lack of trading activity means that these conditions currently exist in a very dormant market. The high CTB might be due to few existing short positions being trapped, or simply extreme liquidity making even a tiny demand for borrows very expensive. It shows the potential ingredients for a squeeze are there, but the catalyst of active trading volume is currently absent. Squeeze mechanics explained. Show animation graphic of short sellers covering positions. So, how does a short squeeze actually work, especially in a scenario like CLRO's? A short squeeze occurs when a stock's price rises sharply, forcing short sellers to buy back the shares they borrowed to limit their losses. This rush to buy back shares, known as covering, creates even more buying pressure, which pushes the price up further, trapping even more short sellers. The high cost to borrow, like the 819.5% we see with CLRO, adds immense pressure on short sellers. Every day they stay short, they are incurring a huge expense. If the stock starts to move up, that expense combined with mounting unrealized losses can quickly force them to throw in the towel and cover, fueling the squeeze. Dilution risk check. An essential check for any potential squeeze candidate is dilution risk. Dilution is when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can depress the stock price and often completely negate any short squeeze thesis, even if the cost to borrow is sky high. In CLRO's case, we've conducted our checks and found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. We also found no recent reverse splits for CLRO in our look-back window. This is a positive sign for squeeze potential, as it indicates the company isn't actively increasing the supply of shares which could otherwise offset any short covering demand. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given CLRO's unique situation, extreme hard-to-borrow conditions coupled with zero volume, what should you watch for? The key here is volume. Chart volume bar. Currently, there's no price movement because there's no trading activity. For a short squeeze to materialize, you would need to see a significant increase in trading volume. This volume could be driven by news, a sudden interest from retail investors, or institutional buying. If volume picks up, with only 100 shares available to borrow and a small float, any significant buying pressure could rapidly impact the price, potentially triggering those high CCB short sellers to cover. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean that existing short sellers have very strong conviction in their bearish thesis and are willing to pay the extremely high fees to maintain their short positions. For CLRO, the question is whether that dormant volcano of hard-to-borrow conditions will ever see the lava of trading volume. CLRO presents a fascinating case study in the world of hard-to-borrow stocks. With an eye-popping 819.5% cost to borrow, a mere 100 shares available to borrow, a tiny 0.7 million share float, and a high squeeze score of 82.6, all the ingredients for extreme volatility are technically present. However, the current lack of any trading volume makes it a stock with significant latent potential rather than active movement. It's a powerful reminder that while hard-to-borrow metrics are critical, they always need to be considered alongside market activity. Keep CLRO on your watch list to see if volume ever enters the equation. If you found this breakdown insightful, please hit that like button, subscribe to the channel for more deep dives into hard-to-borrow stocks, and let us know in the comments if there are any other tickers you'd like us to analyze. Thanks for watching, and we'll see you in the next video.